Good afternoon, this is David speaking here. Today we're going to look at 3 bank shares and why I think they might be good value to buy or invest in the medium to long term. It's currently the 4th of October 2020 and just before the elections, the US elections, Trump currently has COVID and is in the hospital recovering, and a lot of volatility in the market. The bank stocks on both the US and the UK side have been hit significantly, and some are trading below their net book value. So their market value is lower than the amount of money that they've got in the bank. So the market is assuming that they're going to make so much losses that it's going to wipe out perhaps a lot of their net book value as well, and the amount of money that they've got in the bank for a rainy day. Could be true given we've got Corona, but given that 2008 happened and the financial crisis made banks' regulations change, which meant they had to hold additional capital and liquidity. They look in much better shape now than they did last time round and should be able to withhold this pandemic. But that's my opinion. Certainly do your own research, go with your own gut feeling. This isn't advice to buy these shares, it's just something that I think should warrant some further research. So let's jump into the first one, and that would be NatWest Group. NatWest Group previously was RBS, so if you look at the charts, they only start from July this year. However, if you go to RBS, it will show you the 10-20 year charts, and essentially at 109 pence, which the share price currently is, in old money in RBS before the split, that works out as really 11 pence. I think RBS used to be £6 and then went down to 11p because of the problems they had during 2008 financial crisis. Now the government owns circa 70% of the shares, is well capitalised, it's got a lot of liquidity. However, at the moment, the Bank of England has stated that no UK banks are allowed to pay out dividends, therefore RBS can't pay out a dividend, but once it starts to pay out a dividend, which may be soon, may be delayed due to Corona, but if it does eventually, you may be looking at a dividend yield around 10% per year. That's just my opinion, but if you look through things, once the Bank of England's lifted the dividend ban, that could be something that the new CEO uses to drive the share price higher, given that they have sufficient capital in the bank. So if you look at their core tier 1 capital ratios, you'll see they have a lot of capital, and compared to their market value, what here is £13.3 billion. I believe they've got about 30 billion circa tier 1 capital in the bank, so it shows a big buffer for losses. But yeah, certainly do your own research. It's high risk. If you look for the last 10 years, it hasn't moved much, and some people out there would say when it was compelling 10 years ago, what makes it different now? And yeah, it's something to consider. The banking sector at the moment is out of favour. Tech sector is very much in favour, but given that there's limited downside with these low market values compared to net book values, and some of the US banks are certainly profitable still, should reflect similar into the UK. So the second share that I think we should have a look at is HSBC. So HSBC, this is also, the ticker is in London.L, but you can get RBS and HSBC on the American exchanges if you're an American investor. But yeah, so currently HSBC is at £3.08 a share, and if you look at, we're on the maximum chart here, going back to 1988, you've really got to get to 1996, and then again at the bottom with the Asian financial crisis in 97 after that, to hit the lows that we're currently experiencing. So we're looking at 30-year lows for a bank that could arguably be the biggest bank in the world, if not the top 5. And they've got so much liquidity. I believe they've got more deposits than loans. Their market capitalisation is also below its net book value, as in the amount of capital that's got in the bank. But the main compelling thing for me is if you look over what would that be, 20-year period, maybe 30-year period, you can see we're at a multi-decade low here. And if you look over the medium to short term, you would maybe expect it to get back to certainly the £5.50 or the £7.50 mark. Again, similar to RBS, the Bank of England has banned dividends, and once HSBC is allowed to pay a dividend, that should be around the 9%, 10% dividend yield mark also. And if you look at HSBC, it's been a worldwide bank. Okay, it's got issues, it's exposed to China, and it's exposed to America, and both of them have got issues with HSBC from a regulatory perspective, and other things that have been occurring around the world from a political standpoint. However, just the sheer size of this bank and the way it makes profit all around, I agree that there's cost cutting reductions to occur that can go further than currently what's happening. It might be too big to manage, but the sheer size of the different parts of the business and its constituent parts would justify this valuation, in my opinion. I own shares in HSBC, but I'm not saying that you should go and buy them, but it's certainly something that you should look at, and this would be a great ISA play or a dividend income play for a passive investor in, say, a year's time. But yeah, moving on to the third one and the final one for today is Standard Chartered. Again, this one's based in London. Well, the shares are, but you can get them on other exchanges around the world if you're an international investor. Currently on a price to earnings ratio of 6. It does pay a dividend, but it's very small in the grand scale of things. But the main point, similar with other UK banks, as we're talking multi-year lows, and this could be, well, Bank of England rate slightly bottomed. This could be a good time to get into the banking sector, given good news in the US banks suggests that there's profitability to be there during this crisis also. And there's got to be banks at the end of this, and these big players have built moats. Okay, we've got fintech, but the stickiness of customers and clients, especially have got mortgages or loans, and in the UK, certain areas of the UK, the market share of one bank just means that there's not really anywhere else to go if you want a mortgage, a remortgage, or a loan. You've got to go to the likes of RBS, Lloyds, Barclays, not necessarily Standard Chartered. Standard Chartered actually is more Asia focused, and in corporate banking as well as other current banking in Asia. However, it's got trading and other things that these big banks have. It's a bit more of an Asia play, but 6 times price to earnings, low market capitalisation. When you're looking at banks, look at their core tier 1 capital. That's effectively the amount of money they've just got sitting in the bank for a rainy day. If that amount is higher than the market capitalisation, as in here it's 11 billion, it's Standard Chartered's case, well, and I would suggest that at least factor in how many billions of losses you would think that crisis or pandemic or that economic downturn will occur at that moment in time, and take it from there. Do you still think there is this amount of money left in the bank after that crisis is taken all the losses, given or take? They're still going to make some profits elsewhere. And in my view, the banking sector is unloved at the moment. It might take a while for it to be in vogue and in favour. However, in the long run, you should see some normalisation of the share prices that go back up to its net book value rather than trading at a discount to that. So yeah, I'm finished there. Hopefully there'll be another episode soon, or at all, and we'll focus on some other shares when we look at the technology sector. Until then, have a great one.